All right, what is up, party people? It's your boy Nico here. Now, today we're diving into a real case study on one of my C class apartment deals down in Florida. It is a 10-unit Section 8 property we picked up in November of 2023. So, nothing flashy, nothing insane, just a typical C minus class property with all the usual headaches we deal with in this asset class. So, I'm going to walk you through how we negotiated it down, closed it during the peak interest rate season, dealt with all the classic C minus chaos, and now how we're setting this thing up for a killer tax free refinance at some point. This is the real side of multifamily, my peeps, that nobody likes to glamorize, but it's here, it's real, and it's us. This is what we live. This is where the money is made if you're willing to stick with it. All right, here's how it went down. This deal came from the seller who sold us the 44 unit property. He passed on it, didn't want it, didn't want to mess around with it. So I jumped on it. So he was asking like 950 or 925K. And I was coming in at like 780 or maybe 800, I believe. And this is in the springtime of 2023. So maybe even a little bit earlier, maybe late winter of 2023. And I offered 785 or something like that. And he said no. And I knew that I could go more, but we were trying to be sticklers because a lot of the buyers had pulled out at this point of the market. And there were issues with the interest rates being higher than they were a couple of years ago. And it was a very challenging market to get a deal done because investors had also pulled out. So it was a tough deal to get done. And the broker said no, the seller said no to my offer. So this went on for months. And I would just come back with different things saying, hey, look, we could do this, we could do that. And then we ended up inspecting the property and we tried to hammer him again on replacing the entire drain field and septic system. And they took some money off. So it ended up kind of working, but we still couldn't come to an agreement. The icing on the cake was that nobody else was offering on this thing. So months go by and I'm still engaging with the broker, still talking to him, saying, hey, what do you think about my price now, etc. And eventually we gain some traction. Sellers are testing it. They just want to see if you're going to be willing to stick around, or they're waiting for somebody else to come in and swoop it in for a higher price. They're trying to usually get the highest price. Not always, but that's typically what they want, is the highest price. And I just couldn't offer the highest price. But I was the only one bidding, probably. I doubt that anybody else was even looking at this thing. I knew the fundamentals worked for this one. It was fully leased with Section 8 tenants. So that was kind of scary. That was something that I hadn't thought about doing in the past, but we ended up going for it. And it was in our market. This is a Lakeland market that I really love, with my boots on the ground partners. And I just kept at it, kept hammering away, stayed professional, stayed persistent, stayed in their face. And finally, I got it locked up. We settled at 825. I was really hoping to get it for 815. That was my strike price. 825 is where we settled. The guy came down from 925, 950, like I said, whatever it was. So in the end, it worked out. And we were just worried, we were trying to really hammer this home. So just for some context here, we had paid 128.5 per door for our 44 unit. This one was 82,500 per unit. So on a price per door basis, yes, these were smaller. Yes, they're Section 8. Yes, the rents were a bit lower. But on a price per door basis, we were still demolishing the 1% rule here. And we had to, because the interest rates had changed. The lending environment had changed so much that things are different. The pricing had to go down. Now, come closing time, it's always wild. Closing is always crazy. First of all, doing the capital raise, doing a webinar, if you're going to syndicate, sending out marketing material, getting 1,000 no's for 2 maybes is just, I don't love that part of this business, but this is part of it. If you want to get a deal closed, you got to get the capital for it and you got to pitch the deal. I hate pitching because everything is kind of based on hope. And I'm the type of person that if I don't know for sure, I don't feel comfortable telling people about it. What I do know for sure with this particular property, with all the properties that I go for, is that I can get some cash flow for my investors. I go in knowing now, with all my experiences, that I can get some cash flow. That's important. I also know that we're at a 30, 40% discount from what we were in 2020 to 2022. To give you some context, between 2020 and 2023, C-class properties in C neighborhoods were trading for anywhere from 140 to 180 a door. Okay, so we got our 44 unit at 128.5. Excellent. That's a deal, in my opinion, because that was right at the peak right when interest rates started going up. That was when they began in 2022. Now, this 10 unit was probably the peak of interest rate hikes. It was the end of the 500 basis point interest rate hike, so 5 points up. And this was the highest loan that I've ever gotten. And we ended up getting it for 82,500 a door. That is a huge discount. So can you make the deal cash flow in today's lending environment? Yes, that's a go in my opinion. Now we know that the value is going to be there on the flip side. Once the market turns, you got to make it to the end of that. So for me to sell the property, it's like, well, look, we're going to have cash flow. I can't guarantee that the market is going to shift within 2, 3, 5, 10 years. It will shift. Historically, it always does shift back to a seller's market, but I can't promise it. So I don't feel comfortable pitching those things. Anyway, now back to the closing table. So we go to close, and I just so happened to have to be supervising a flag football game at my school. 10 minutes into the game, my phone's blowing up with the attorney on the phone, with my broker on the phone. I end up getting both of them on a three-way call, losing my mind because this broker just wants his fee cleared for that particular day. We couldn't clear it. We couldn't have the funds transferred that day. It was too late in the day. Ridiculous. But the broker was giving us hell. He wanted to get paid, and I get it. So there I am in front of my new principal, who's watching me like a hawk on the phone for 10 minutes or so. It literally felt like hours, trying to calm this broker down with my attorney on my side, explaining to him the situation while kids are running around playing on the field. It was tense, but we got it done. The funds cleared the next day. The deal closed. Welcome to multifamily. Deals don't wait for convenient timing. Just like my last deal, the 6 unit in Plant City, I closed while working at a restaurant as a waiter. Freaking crazy. All right, now we'll get to the loan. So the loan, we locked in a 7.93% interest rate. That's the worst loan that we've ever had. Here's the thing. The historical average interest rate is about 7.7 or 7.71. Most investors don't realize that, and they're spoiled by the 3% rates that we had just seen over the past few years prior to this interest rate hike. The deal still worked because the fundamentals were solid. We raised the capital, we closed it, and executed the plan to a degree, which I'll get into. We ended up deciding to skip renovations. Our business plan was really no big renovations. Instead, we focused on cleaning units, minor turns, collecting stable rents. Here's why. At today's rates, heavy capex for a small rent bump just doesn't pencil out. Rents today are flat, sometimes declining, and sometimes you can get, depending on where you are, can get a small bump from where we were 2, 3 years ago, but it's typically not going up much. So the ROI is not there if you're going to pump in a bunch of money for capex. We held the renovation capital and parked it in a Raymond James money market account, earning about 5% for our investors. So we still have that capital. And the game plan right now is to wait until better times where we have proof of concept to where if we're going to renovate a unit, we can get X amount of rent bump. Right now, we're basically getting market rents without doing anything, which is incredible. And yes, the units are clean. Yes, the units are turned to the standards that they should be. Yes, they qualify for Section 8 renters. No, we don't have any complaints from our tenants. This is how we're supposed to be operating. And this is actually a great strategy, which I recommend to you guys. Hold off on heavy renovations. Do not over renovate the property because it's not going to pay you dividends in return. Now, having the money in the Raymond James account is legal. You need to talk to your attorney about how to structure it. But yes, we did it the right way. We have money that we can pull out immediately if we need to for any unforeseen events or any issues that we need, or even to do the renovations whenever we want, or even to just distribute it back to our investors. So we're gaining 5% on that, which is awesome. And yeah, we're making distributions on this one. We have not hit our preferred return, but that's okay. We're waiting for the right market cycle to justify bigger rent bumps. And when that happens, a lot of things can happen. We can probably begin hitting our preferred return. We can start thinking of other strategies, etc. But let me pause for a second because I want to talk a little bit about some wildness. Like every C minus property, this place came with its quirks. We had druggies hanging around, people camping in common areas. We found them sleeping in the shed, sleeping in the common area in the center. It was just literally like a screened in awning and people are sleeping. And yep, we had a guy literally living in a boat in our parking lot. He pulled a boat that was definitely not a functional boat. I don't know where he got the boat from. This was his only possession. It was parked, dropped. There was no truck attached to it. It was just a boat that was dropped in our parking lot, and the guy was living there, using our water and probably borrowing people's bathrooms from time to time if he needed to use the bathroom from the druggies that were living there as well. This is why having strong local partners really matters, like Mark and Emeka. My partners, those are the boots on the ground guys down in Florida. They handle it. They have thick skin and zero fear. These guys are awesome. And the good news with this type of property, even with the druggies, even with the issues that we face, is that delinquency is not an issue. Section 8 pays like clockwork, which is why I love subsidized tenants in certain markets, of course. And I really enjoy having these Section 8 renters. And honestly, I'm really trying to find more Section 8 renters for our other properties. It's just difficult to find because there's not many Section 8 vouchers that are given out. There's a huge wait list, and it's sad. But Section 8 is incredible. I really do like it as a strategy for my multifamily properties. Now, our biggest hurdle has been that 7.9% loan. It's huge and a 25-year amortization. So it's really eating up cash flow. And the local bank that we got it from, it's Fairwinds Federal Credit Union. I really love working with them. I have 4 business accounts, 1 personal account with them. So I have a great relationship. They've done a bunch of our deals for us. They're great. But I keep pushing them to do a loan modification because the terms that they're handing out today are much better, at least a point less. So they're in the 6.5 range, maybe even lower than 6.5. So I'm trying to get them to do a loan modification. But even with this long-standing relationship, they're just not budging. So I ended up calling a mortgage broker, somebody to shop around for me. I'm tired of doing the work and I'm tired of people that are just sitting there and, yeah, we have a good relationship. So why don't you just modify the loan? I know that you're going to lose out on money, but I give you a lot of business. So honestly, you should do it. Anyway, they're not doing it. After reaching out to a mortgage broker, he came back with a 6.5% interest rate, 30-year amortization, and enough proceeds to give back 35 to 40% of my investor capital, tax free. Guys, when you do a refinance, that refinance is tax free. You pull money out of the property without paying tax. Very different from a sale where you now have to pay tax on that. Here's the thing though, on this current loan that we have a 3211 prepayment penalty. What that means is you have to pay 3% of the loan balance back to the bank if you sell within year 1, 2% if you sell within year 2, 1% if you sell within years 3 and 4. After that, there's no prepayment penalty. So there's different types of prepayment penalties. This is just a step down prepayment penalty, which I like. It's very simple. I go for these typically rather than defeasance or yield maintenance, which usually Fannie Freddie or agency lenders offer as a prepayment penalty. But I just don't understand them well enough to feel confident doing those types of prepayment structures. So I tried to negotiate a simple 3211, 311, something like that, so that we can get out of the deal if we need to without a hefty hit to our cash. So 1% of a $500,000 loan is $5,000. So if we wait until November to refinance this thing, not too bad. $5,000, not a big deal in my opinion. We will likely wait until at least November because that's when we hit that 1% fee. And in reality, we will probably going to wait more, but the ideal scenario would be to modify the loan and just wait until we can do a full cash out refinance, pay our investors back the full 100%, and roll into what we call infinite returns territory. That is the goal. So an infinite return is when you have all of your initial capital that you invested, you have that back, and now you're still getting cash flow on that because you don't lose your equity ownership necessarily, depending on the structure, when you get all of your cash back. You're still getting that same ownership. So if you own 25% of the deal, you get all your money back. Let's say you're still going to get 25% of the cash flow. It's really epic. So that's where investing in real estate is very different and very powerful compared to other investment vehicles. All right, let's switch gears for a second. In 2024, after a year of owning the property, we got hit with a hurricane. Okay, I don't remember which one it was. It doesn't really matter. Hurricanes come through Florida all the time, and we're in a location where I feel confident that we are safe from the hurricanes in terms of flood. None of my properties are located in a flood zone, and we have to worry about wind to a degree, but obviously we have insurance for all of this stuff. But wind will typically rip off shingles, cause some maybe siding to come off, etc. Honestly, we've never had that much damage, knock on wood, from wind, and we could just wrap it up pretty quickly and not even file a claim for it because it's not worth it if you have some wind damage. But We had a lot of rain come down for this one particular hurricane, and that rain was pooling up and creeping inside the apartment. So a few of the apartments got some water inside from the rain. It's not a flood zone. I got to be very clear on that. And we've ended up trying to go through an adjuster. We filed a claim, hired an adjuster, hired an attorney, and this was a big mistake. And I'm going to shout this guy out right now. His name is Jamie Tasker and his partner Reed Baldwin down in Florida. These guys were absolute nightmares. They were clowns. They took $10,000 from us, delivered nothing, gave us the runaround. And if I went farther, they were going to pursue legal action or defend themselves legally. It was just a joke. Money hungry clowns. They could have structured it very differently. And in the end, they just took advantage of us. I needed to say this because if you're going to go that route, you just got to be careful with who you choose. I knew that these guys were kind of iffy from the beginning, but they offered me a good pricing structure and I took it. My fault as well. I should have gone with a real professional, but you live and you learn. We lost $10,000 on these clowns and I will never work with them again. So there you go, guys. Jamie Tasker, Reed Baldwin down in Florida. Just think twice about using them. Here's the lesson. Bad vendors are just part of the tuition, guys. You eat it, you learn, and you move forward. And me, I am moving forward. Got that off my brain, and let's keep going. So here is the key takeaway. This is what you should take from this lesson. Persistence wins. Most people quit too early. High rates do not kill your deals. Bad underwriting does. Remember, cash flow first, renovations later. Timing is everything. You need strong boots on the ground partners. That is a non-negotiable. Doing a refinance is how you can pull out your money tax-free. That is an epic way to grow your wealth. That's how you build. That is how you grow. Stick with it, guys. Vendors are going to burn you. Learn fast, move on. I lost $50K from one vendor, got it back. Now we had these guys take $10K from us. Oh, well, moving on. We love this little 10 unit in the end. It's not glamorous. It's not a unicorn, but it is steady and it steadily builds wealth. If this case study helped you see what real multifamily looks like, screenshot it, share it, and tag me in it wherever you post. Make it Instagram, make it TikTok, make it Snapchat, make it LinkedIn, make it Facebook, make it whatever you want, make it real. And if you want tools to get into this game, go get my multifamily credibility kit from smallactscommunities.com. Download it, build your foundation, swing that small axe, and I will see you guys next week. Love you. All right, and that's a wrap, Small Acts community. So I wanted to take a minute to say thank you so much for listening to the show. And if you liked it or got any value from it, it would really mean the world to me if you would share it with someone else and write a review. Remember, guys, keep sharpening those axes. Let's get out there. Let's crush it. Love you guys.